Okay, so welcome everybody to the Canadian Physicians Pension Plan webinar tonight. We're going to get started, and I would like to introduce myself. First of all, I'm Vuket Tran. I'm the president of the Canadian Physicians Pension Plan, and we have with us tonight Mr. Jean-Pierre Laporte, who's the treasurer of the Canadian Physicians Pension Plan. But Mr. Laporte is also a pension lawyer. So I'll let JP introduce himself, and then we'll get started with your presentation.
Yep, thank you, Dr. Trent. So I am a pension lawyer. I've been practicing pension law for 24 years now. And I'm very passionate about pension solutions for incorporated professionals like doctors, dentists, accountants, lawyers, and pharmacists, and others who need to have a real pension solution when it's time to stop working. So tonight we're going to be focusing on what physicians are missing out when it comes to retirement planning. And I have a roadmap for us today. I want to start with a review of the RSP very, very briefly. Everybody knows RSPs, or they should, and they're extremely prevalent. About 98% of people are using those. Second, a review of using the Medicine Professional Corporation as the primary way to save for retirement. This is what so many professionals do, not just doctors, but others.
Other
And
and
some feedback here. And the last one is review of the Canadian Physicians Pension Plan as a contrast to these two very well-known ways to save for retirement. So if we start with, we begin at the beginning. The truth of the matter is this, is that physicians, dentists, self-employed professionals, etc., do not have gold-plated pension plans. Generally speaking, there's the odd exception. And I know one of the participants tonight already has an individual pension plan. But the overwhelming majority of physicians do not have a true gold-plated pension plan. And yet they deserve it because, well, for a number of reasons, I don't want to get into that. And instead, unfortunately, what's happening is that the financial industry is telling physicians to save through an RSP or by keeping the money inside their medical professional corporation. Of course, there's some people who will also say, just buy some life insurance, but we're not even going to go down that path. So this is sort of what the industry is telling physicians, and we're saying if you really want a pension plan, you should get a pension plan, not some other mechanism. Why? Well, because the RSP was really meant for what we call the middle income people. Someone that's making between, I don't know, 50 and $150,000 of salary. RSP, it does a pretty decent job. If you're low income, by saving through an RSP, assuming you have the means to save, it might even claw back some public pensions and public services. So you're hurting yourself. And if you're high income, it's just insufficient. The annual contributions available under an RSP just cannot provide enough retirement income for someone who has a higher income. And what we think is that you should have an RSP if you are really in between those two extremes. Most physicians are more towards the higher income bracket. When I say that, I mean the combination of any salary and dividends taken are in excess of $150,000 on an annual basis. So turning away from the RSP for a second, which only has one annual tax deduction, 18% of last year's earned income up to a maximum, which this year the maximum is 32,490. So if we move away from the RSP with its single tax deduction and look at the use of a medical corporation instead, as the way to save for retirement, we find that unfortunately this approach um, creates all kinds of tax issues for the physician and their family. So let's look at that strategy for a second. The strategy that so many physicians have followed all along, which is let's pay the least amount of tax up front when it's collected from OHIP on the first $500,000 that the corporation earns. I'm only paying 12.2% because it's active business income. If I'm a specialist or if I'm making more than $500,000, then I only have to pay 26.5%. In both cases, it's much better than receiving all this OHIP income personally and being exposed to a potentially 53% tax bracket. So the idea, the received wisdom of using the corporation as the primary way to save for retirement is to pay the least amount of tax up front. And then with the retained earnings, the dollars that haven't been paid out after you paid your active business tax, was to save those typically in capital assets, meaning assets which won't generate any taxable income unless you sell it in the future, like buying shares of companies on the stock market, buying units of mutual funds that don't pay dividends or distributions, buying real estate and hanging on to the real estate and not collecting any rents, just letting the value grow. All of these capital assets come with what we call unrealized gains. So there's growth that's happening that you don't have to pay tax along the way because you haven't liquidated it. So there's no realized gain, therefore no tax. And the received wisdom was to then say, when I am old and I can no longer practice medicine, I will have all of these unrealized gains in my corporation and I can start liquidating, selling off some of this property. Well, my company will. And with the cash, I'm going to pay myself a dividend and get the money out, and I can live off of those dividends. That's going to be my pension. So I hope this sounds familiar for a lot of people. Um, well, I don't hope it because you'll see that this is not the most tax efficient way of doing it, but that is sort of what we've been hearing for years and years. Now, let's review what that means from a tax perspective. So, first of all, we're exposed to a first layer of tax, the active business tax, which in the best case scenario is only 12.2, but could be 26.5. When the retained earnings are kept in the corporation and invested, if any of that stuff generates any kind of income, whether it's interest income, foreign dividend income, Canadian dividend income, or capital gains, that's no longer considered active business income. It's passive investment income. And unfortunately, the tax rate in Ontario on that particular income is over 50%. It's 50.17%. It's a little bit higher in Quebec and depending on the province. So we got a second tax leakage. Then we have the tax on passive income. So if the corporation is generating more than $50,000 of passive income, what happens is that we start grinding away at the $500,000 small business allowance, the first $500,000 of OHIP income that was benefiting from the low 12.2%. Well, we lose that $500,000 eventually, and every dollar earned by OHIP, by the company from OHIP, sorry, is now exposed to a 26.5% tax rate upfront. So we more than doubled our tax rate on the active business just because we happen to have a little too much passive income accumulating within the medical professional corporation. So that's not good. That's a third way of losing money to the tax authorities. And then finally, when at the end of the day we decide to pull money out in the form of a dividend, we have to pay personal tax on the dividend received by the doctor from their professional corporation. So we're up to the fourth layer of taxation. Oh, and let's try not to die. Because if you'd pass away, the shares of the professional corporation, which were worth nothing when you incorporated, but now they're full of millions of dollars of investments, those retained earnings, those unrealized gains. Now those shares have to be deemed disposed. So the estate's going to have to pay a tax on the difference between what the value of the company is now, even though it's not being sold, and what it was worth when you incorporate it. So a fifth layer of tax. And if you say, you know what, enough is enough, I'm leaving Canada, I'm tired of this tax regime, I'm going to move to another jurisdiction that has a more favorable tax treatment, the CRA gets you one last time with what's called the departure tax, the deemed disposition on your assets that are valued upon the point of departure versus what you might have paid for them. And it's not even listed here, but there's a seventh potential tax, which is probate. If you don't have a corporate will and the shares of your corporation flow through your regular will and has to be probated by the court, which is about 1.5%. So, very, very tax inefficient way to save for retirement if the objective is to put aside money for retirement. Now, we have six, potentially seven tax leakages that are destroying the wealth you are trying to accumulate. But what about if a pension plan was used instead? What happens then? Well, on the contributions made by the professional corporation to the pension plan, there's no 12.2% tax, there's no 26.5% tax, there's zero tax because the contribution to the plan is an expense, it's a tax deduction. So that first layer of taxation doesn't even occur on the dollars that are contributed to the plan. So the higher the contribution limit, the better. What about the passive investment income once the money's sitting inside the pension plan? Well, there's no 50.17% tax. It's 0% tax because the plan itself, the pension plan is tax exempt, just like an RSP would be. There's no ongoing tax on the growth. What about that tax on passive income when you've exceeded $50,000 of passive income within the PC? Well, we don't care if there's passive income inside the pension plan because the pension plan is off balance sheet. It's not an asset of the professional corporation. So it doesn't matter how much passive income is generated within the pension plan. It's not going to grind away at the $500,000 small business allowance of the medical professional corporation. So we're not seeing the tax rate jump from 12.2 to 26.5. It's staying put at 12.2 if assuming you're below the $500,000 level. What about if you die with your spouse, but your kids are part of your plan because they were on the payroll? Well, in that case, the deemed disposition on death doesn't apply to your pension assets. The millions of dollars that you were able to stash away in your pension plan that you were going to be using to fund your retirement becomes pension surplus. And because it hasn't left a plan, it's not subject to tax. So the children that are also members of the plan now have access to the surplus if they need to. But if they don't need it right away, they don't have to pay tax. So instead of giving half your wealth to the government inside of your pension, you're giving it to your children instead. To me, it's a better use of money, but that's a personal choice. And then finally, what if you leave the country and you said, you know, enough is enough. I'm moving to, I don't know, Grand Cayman or some other part of the world where the tax authorities are not really that prevalent. Well, there's no departure tax on the assets in the pension plan because every dollar inside the pension plan is characterized by CRA as an exempt asset. Therefore, zero departure tax. So really, what are we left with? Well, there is tax payable, and it's the tax that's owed when you receive your monthly pension from the pension plan. So there will be some personal tax. This can't be perfect, but that personal tax could be as low as 15% if the physician decides to retire outside of Canada as a non resident, for example. It could be 25% if you retire in a tax haven like Grand Cayman, for example. And then it could be lower than the top bracket if you are able to do pension income splitting with a spouse, if you have a spouse in retirement. So, all this to say that we have choices. We could certainly continue down the path of using the corporation, but we see what happens with the 6 tax leakages. We could do the one annual contribution to the RSP, but that's just not enough. Or we could go with a pension plan and mitigate a lot of these taxes and push the tax bill well into the future and only on the monthly pension that we receive every month. So there's a real gap in terms of the different strategies that exist, but most people have no clue about pension plans. Therefore, they're going to do what everyone else is doing, RSP or saving to the corporation or a mixture of the two, or sometimes use some insurance. So how can we help mend this gap? By using an individual pension plan or a personal pension plan, we're able to provide a secure retirement income stream and do it in a tax deferred environment. Because every time the professional corporation contributes to the plan, that creates tax deductions. And the funds themselves, just like inside of an RSP, the funds themselves grow without any tax. Tax is pushed into the future. And therefore, we're starting with 100 cents on the dollar from day one instead of partial dollar being invested and then bleeding money along the way. We preserve the power of the money that we earn from OHIP and put it to work from day one. So we have the time value of money working in our favor, interest on interest with no tax. But what else? What else is there? Because, you know, if we want to look safer retirement and we don't favor the RSP, we don't favor using the corporation as a primary tool, what else do we have? Well, we have the CPPP. And the reason why it's important to pick the right tool when you're trying to do an application is because tax optimization can be done in many different ways. But, and I use this analogy, I know that Dr. Tran is not so keen on it, but I like it. I think it's funny. I mean, if you're doing heart surgery and you have to cut open someone's rib cage or sternum, you know, you could use a scalpel or you could use a butter knife. In theory, both will get you to the same result. But, you know, one is more slick and professional looking than the other. The end result won't be the same. And it's the same thing when you're thinking about retirement. If the goal is to maximize your retirement nest egg, minimize your taxes along the way, you have to use the right tool. You can't be using a highly taxed solution like the professional corporation or an inadequate solution like the RSP. You need to be in a registered pension plan. And that's what we're going to be talking about tonight. Because in Canada, there's a massive blind spot in the financial industry. And virtually nobody is doing pensions. Only 2% seem to have discovered it and are using it to their advantage. 98% are still languishing in RSPs or using their corporation instead of using the proper tool. So tonight is really, hopefully, for some of you, it'll be an eye opener. Now, I promised you in my roadmap that the third item would be the CPPP. So now we're getting into the meat of things. And what is the Canadian Physicians Pension Plan? It's really a federation of personal pension plans. Now, it could be an individual pension plan, it could be a PPP, doesn't matter. It's a pension plan for typically just a doctor, physician, maybe their spouse, sometimes their kids, but really each family has their own pension plan. So it's not one big pool like the Healthcare of Ontario pension plan, or there's the Medicus pension plan that Scotiabank brought out. This is a federation of individualized pension plans for each physician joining. And you'll see why that brings a whole bunch of advantages that the other larger plans don't have. So the building block of this federation is this personal pension plan or individual pension plan, doesn't matter. And this slide is very dense, has a lot of bullet points, but it's probably the most important slide of the evening because on a single image, we've broken down three key elements of value that comes with this individual plan. One being enhanced contributions. So contributions that you cannot do with an RSP that you can do with a pension plan. Special deductions, which are unavailable for those who use an RSP. And unique tax optimization strategies, which comes with being in a pension plan, which generates significant amounts of extra wealth. So when you add those three together, you really have the unique value proposition of this solution. And this is without the extra advantage of being part of a federation, which we'll get to later at the end. Well, let's start with the building block. So what can you contribute to a pension plan that you can't contribute to an RRSP? Well, first of all, you can do what's called a past service contribution. So if you were in receipt of T4 income from your professional corporation last year, the year before, or since you've incorporated, we're able to calculate an amount of money that your company can contribute, which is fully tax deductible to the business, not taxable to you, and that will now go into your pension plan so that you have a lot more money to start than if you're just contributing the annual contribution for 2025. We can go back to the time when professional corporations were allowed in your province, like in Ontario. It depends which province you're in, but for Ontario, I believe it's 2004 or something. So that's over 20 years of potential salaries that could be captured by this one initial corporate tax deduction. Then we have the current service. So I've already mentioned when I was talking about RSPs that the rule is 18% of last year's earned income up to a ceiling. With pensions, it starts at 18% and it ratchets up, it goes up every year until you hit 64, at which point the percentage instead of being 18 is almost 30%. And then it tapers down slightly down to 24% when you hit age 71. So we have an absolute annual contribution advantage, meaning we can put more money than the RSP individual every single year, which not only means more tax deductions, which means less tax, it also means more capital that's now growing sheltered from taxation within the plan. So we have a twin effect acting in our best interest. We also have the RSP double dip. So not only can you put more money each year than under RSP in the first year, we're also allowed to put money in an RSP and get a personal tax deduction. So our clients who sign up with us are potentially looking at 3 tax deductions right away. One for the past, one for the current year, and one for the RSP. Then there are special payments. These are additional corporate tax deductions that arise when the investments within the pension plan generate a rate of return that's below 7.5% net of fees. So let's say the money manager is earning 10% and there's like 1.5% in fees. So you are at 8.5%. then you don't have any deficits. The plan is fully funded. If the stock market takes a beating because of some geopolitical event like we've had with in the past, and the rate of return drops below 7.5, the professional corporation has the legal right to contribute extra money. That's what we call a special payment. And the idea of the special payment is to shore up the assets, to bring them up to where they ought to have been had the plan been able to generate 7.5%. So it's a way to backfill losses with extra tax deductions. But those special payments are not mandatory. If the corporation doesn't have the cash, or if there's no desire to use the cash for the pension plan, there's no legal obligation to make the special payment. It's just there if you want it. And the last special contribution that RSP savers have no clue what I'm talking about is terminal funding. This is an accelerated payment that can be made if the physician decides to turn on the pension. So at, let's say, I don't know, age 60, age 55, age 52, age 50, at some pre-retirement age, because normal retirement is 65. So if the decision is made to turn on the tap and to start collecting a pension years ahead of schedule, years before 65, terminal funding can be activated, and the corporation gets to write a massive check, typically to the pension fund, and claim that as a corporate tax deduction. And I've seen some terminal funding amounts for physicians where it's looking like 1.8 million, $2 million of write-offs, just because they decide to turn their pension, 5, 10, 15 years before the normal retirement age. So having all of these enhanced contributions means that we can triple, sometimes quadruple, the amount of tax assistance that you would otherwise get if you just maxed out your RRSP every year. I have to let that sink for a second, because some people say, well, what do you mean 3 to 4 times? How can the government even allow that? That doesn't seem fair for all those people that are using RSPs. Well, I don't make the law. It's in the Income Tax Act. You can look it up. If you want to learn about the RSP, it's section 146. If you want to learn about these plans, it's section 147.1. And you'll see that the legislation is significantly more generous when it comes to a pension plan than an RSP. So all we do is just apply the law to the advantage of our customers. So in addition to all these enhanced contributions, which of course the RSP saver can only dream of, we also have access to special deductions, which don't exist for people that have an RSP. And the point of a deduction is to reduce your tax bill. So admin fees, the fees paid to CPPP, investment management fees paid to the money managers, which is not CPPP, and the interest, any interest paid to a lender if the corporation is borrowing to contribute to the plan, all of these amounts trigger additional corporate tax deductions for the professional corporation. And then if that wasn't enough, because this is a pension plan, remember my butter knife versus scalpel analogy, we now have access to some unique tax optimization solutions. One is the ability to do pension income splitting before age 65, because you can tell me, yeah, I can split my RIF income with my spouse, but you can only do that once you're 65. With us, you can split your pension income at any age. Treaty tax reduction. So this is where if you decide to become a non-resident and you're collecting your pension in about 100 countries around the world, the tax levied by CRA on your monthly pension is 15%, not 25%, which is the normal rule for non-residents. Purification for the lifetime capital gains exemption. So this is for those who find a way to sell the shares of their corporation and want to trigger the lifetime capital gains exemption. One great way to purify the balance sheet is to move passive assets off the balance sheet inside the pension plan. So that helps qualify for that $1.25 million tax-free capital gain. Protection from the tax on passive income, we've already talked about it. If you have passive income inside your pension plan, it's off balance sheet. So it doesn't create a drag, a grind of your $500,000 small business allowance on the OHIP income coming in. And the intergenerational wealth transfer, which is the ability to pass wealth to loved ones like children that happen to be part of the plan because they work for the professional corporation in some capacity at some point in their life. So massive, massive, sometimes multi-million dollar tax savings, which layer on top of these other tax savings, which we have in the two left arrows. And the point of saying all this is because my view of things, and this is just my personal opinion, but my view is thing is if we're able to create incremental layers of guaranteed value, value that doesn't depend on taking risks of, picking stocks and hoping for the best. If we can guarantee the value by not having to pay the CRA as much money, that's money in the pocket. That's guaranteed. And using all of these rules, when we put them all together in this elegant solution, that's how we guarantee value. And that's the kind of value that I like. Things that I can count, that I can put in my pocket, that doesn't depend on taking market risks. Now, I went over the intergenerational wealth transfer element quickly, but it's so important for those who have children who are able to put them on the payroll of your professional corporation, even if it's minimum wage, even if it's part-time minimum wage. But if you're able to put the children for a couple of years and make them employees, by being an employee, they're allowed to join your pension plan. It becomes a family pension plan. And because everything is going into one single communal pool of money, if you were to pass away, the liabilities, meaning the promised benefits payable to you, are extinguished. There's no one to pay a pension to. So the cash that's still in this communal pool becomes what we call pension surplus. And since the children are still entitled to their pension when they turn of age, they have access to their money and your money. And so long as they don't pull it out right away because they don't need it, there's no tax at all. So the difference is between giving over half your wealth to the CRA or giving it to your children instead. That's why I wanted to spend a couple of seconds on this concept, because I would say 99.9% of people have no clue that this is even possible. And yet it's been part of pension law for many, many years. Think of the Canada pension plan. You're entitled to a pension. If you pass away, your spouse gets a survivor pension. When the spouse passes away, short of the $2,500 death benefit, nobody gets anything. Where's all the money gone? The money is in the pool. It stays with the Canada pension plan. That's the surplus. Well, the same principle applies here, except at the micro level of your professional corporation. Same rules. It's been under our nose all these years. So I mentioned income splitting as one of the optimization strategies. I have a little illustration here to demonstrate sort of how powerful this can be. So let's arbitrarily say that the pension plan is paying an annual pension of $163,909. I took that from an example, an actual example. And if you don't do anything, you just declare that on your tax return. In Ontario, you'd be paying roughly $52,100. But since this is a pension and we're able to transfer 50% of that value to the tax return of our spouse, assuming the spouse has no income, like a stay-at-home spouse, for example, then what happens is the spouse has to pay tax on that 50%, and you pay tax only on the other 50% because you've transferred it to another tax return. So when both parties are paying tax, each one pays 17,324. So as a couple, as a unit, the household pays a total of $34,648 in taxes. Well, that's a lot better than 52,100. In fact, that's $17,452 in taxes saved that is not going to the government that year, that I'm keeping in my bank account. That's every year. Why? Just because I did this paper exercise with my accountant. And I said, please transfer half of my annual pension to my spouse's tax return. All right. Enough about taxes. I don't want to lose too many people. I don't want people to fall asleep. Let's switch gears a little bit. No pun intended, looking at this image. And let's talk about superior investment solutions. Now, these pension plans, these registered pension plans that we've been talking about for the last little while, are not RSPs, which means that the scope of potential investments is significantly greater because when you have an RRSP, you're restricted to what you can invest in by what are called the qualifying investment rules, which are found mainly in regulations under the Income Tax Act. When you have a registered pension plan, which is what we are talking about tonight, we don't follow the qualifying investment rules. Those rules have no application. We follow what are called the federal investment rules, which are found in federal pension legislation. Doesn't matter where in the country, pretty much, they're all incorporating by reference the federal rules. Well, the federal investment rules allow you to do whatever an RSP can do, plus, plus, plus. And there are certain asset classes that are not open to an RSP saver, but that would be open to a pension saver. And I always use the example of the 407 toll highway, which is probably one of the most profitable companies in the country. Well, no kidding, they've got a monopoly. They can charge whatever they want every time someone uses that damn highway. Well, if you can charge whatever you can or want, you're pricing right along the demand curve. So they're generating massive profits. And who owns the 407? A bunch of pension plans. Well, if I go to the bank and open up an RSP and I say to my banker, hey, I've given you $1 million of RSP money. Can you buy a chunk of the 407? The branch manager is going to laugh me out of the branch and say, I'm sorry, sir. We'll have some nice mutual funds for you that the bank created, but you can't invest there. That's for pension plans. Well, I'd like to have access to superior investments. Can't do it through the RSP. You got to use the right tool. Another example is real estate. A lot of people love private real estate. Many doctors have bought real estate through their corporation over the years for the very reason, because they can control it, they see the value going up, they can collect rents in the meantime to help pay the mortgage or the upkeep, the taxes. But wouldn't it be better to do private real estate in a tax sheltered manner instead of in a highly taxed manner? Well, you can if you have a pension plan, because pension plans can band together and purchase shares of a tax exempt pension real estate corporation. And the reason why that's allowed is because the pension realty corporation can only have registered pension plans as shareholders. It won't allow anyone else but a tax exempt pension plan to be a shareholder. So let me show you a quick illustration. Imagine that we've got a whole bunch of physicians in a clinic. Well, this is a very small clinic. There's only 4 of them. And there's John, Julie, Sunil, and Don, and each one's a physician. They all have their medical professional corporation. And so everybody sets up their own pension plan. But John's a bit of I don't want to say weirdo, it's just a bit of an odd duck, and he doesn't believe in investing in real estate. So he just does stocks or bonds or GICs or whatever he wants. But his three fellow colleagues in the clinic um, love private real estate. In fact, they've got their eye on this beautiful commercial building on Main Street. So each pension plan can buy shares of a pension realty corporation, which is tax exempt. Remember, the only shareholders permitted are tax exempt pension plans. And in turn, the pension realty corporation becomes the landlord of this real estate, this private real estate. Any rents collected from the tenants go up to the pension realty corporation tax exempt because it's tax exempt. Any dividends that the pension realty corporation pays back to the the investors, the pension plans, is also tax exempt because the pension plans are tax exempt. So we've created a mechanism, very simple, to deploy capital in private real estate, but all of it in a sheltered manner. So that's one example. And some of our CPPP, actually all of our CPPP doctors that are investing with us have access to some of this private real estate as part of their portfolio. So switching gears again from just talking about investments and kind of pulling all these strands together. What are some of the benefits of being in a registered pension plan versus being in an RSP? Well, conceptually, because we're able to put more money to work to contribute a lot more, 3, sometimes 4 times more than an RSP, with the passage of time, assuming the rate of return generated is identical, we're not taking extra risks. But just because we're allowed to put more money, we end up with a significantly more income and more assets in retirement. It's that simple. So let me give you a practical example. Imagine a 47-year-old physician that's growing their money and they're using either an RSP or a pension plan. So if they're using the pension plan, they're using the blue line. If they're using the RSP, they're on the orange line. And in both cases, the assets are growing at the same rate of return. But what happens is, because we're allowed to put more money in the pension plan and the RSP, when you calculate how much is available in retirement, there's a gap, there's a delta. And in this simple example, over about 17 years, we are looking at $693,000 more. But we haven't taken extra risk to get there. We've used the exact same portfolio. It's just that we were able to contribute more. And I've already alluded to this. The legislative advantage of being in a pension stems from the Income Tax Act. It's because we're relying on Section 147.1 and its regulations, whereas the 98% who are still in la la land and using RSPs are relying on Section 146. And, ignorance of the law is very costly because if you don't know which tool to use, if you're still using the butter knife instead of the scalpel, it's going to be messy. Right? So the key is get the proper tool, get what the law provides, maximize it, use it to your advantage, build up that wealth in a guaranteed fashion instead of, praying that the stock market's going to be favorable to us. I'm not interested in that kind of value. I like guaranteed value. Now, CPP is available in all provinces and territories for physicians. It's approved and regulated by the federal government, by the Canada Revenue Agency. And in a couple of provinces and territories, it's also regulated at the provincial or territorial level. In Ontario, so long as you own at least 10% of any shares, any class of shares of your own medical corporation, you don't have to register with the province of Ontario. It's only the CRA. Now, I've talked a lot about the solution, but I haven't really opened up the hood and looked at the moving parts of who does what in order to make this happen, because it's a team effort. And what we've done is we've tried to pull together some of the best in class partners. So the monies, for example, the contributions made don't sit with CPPP, they sit with Fidelity. They're at Fidelity Clearing, which is the institutional custodian. That's a subsidiary of Fidelity Investments. The monies are not invested by Dr. Tran and they're not invested by me, even though I have the title of treasurer. I actually don't touch the money. The money is invested by the professional money managers at Vector Global, and they have access to a number of portfolios. If we're doing any insurance, we'd be using Manulife, which is, I think, the largest life insurance company in the country. And in terms of the administration, it's usually done by Integris, which is my firm, but we have the backing of Industrial Alliance Financial Group, which is the fourth largest life insurance company in the country, and their team of actuaries and administrators to handle sort of the back office stuff that nobody wants to do, but is necessary when you have a pension plan. So that's kind of the A team that we put together so far. Um, the elephant in the room, of course, is always the pricing. It says, well, all you've done is tell me advantages. What's the catch? What's the downside? How much is it going to cost me? Break it to me. Well, the good news is this, is that while there is an annual fee, which is tax deductible, if you have more than $500,000 of assets coming into the plan or eventually get to that level, we gradually reduce the annual fee by 25% year by year. There's no setup fee, by the way. A lot of people ask me, what's the setup fee to get this off the ground? We don't charge one, we waive that. But what happens is once you have $500,000 of assets, at the end of year one, 25% of the 2,800 is reimbursed. So the real cost is 2,373. At the end of year two, 50% of the 2,800 is reimbursed. By the end of year three, it's 75%. And at the end of year four, the entire annual fee is reimbursed and for subsequent years. So fee really should not be the reason not to do this. It shouldn't be, even if we didn't have this mechanism in place, because the multitude of additional tax deductions that we've been talking about, past service, higher annual service, RSP double dip, special payments, terminal funding, all of these, plus the investment management fee deductions, et cetera, all of these deductions create tax refunds or tax savings that didn't exist before. So those dwarf are way higher than this annual fee that we're talking about. So really what I'm trying to get to is that the solution auto finances itself, which is extremely rare that you find something that pays for itself. But when you understand how the Tax Act works, you can see that by claiming much higher deductions and paying less tax, you've created wealth that didn't exist before. And some of that is used to pay our fee. The rest is bonus. It's just gravy. So in order to get started, we usually recommend that people start with a complementary illustration. And that illustration is designed to provide you with some meaningful data, such as how much you can contribute for your past income if you've had salaries in the past from your corporation. How much will your future contributions look like or be? How big will those be compared to an RSP? And what can you expect in terms of income at retirement at different ages? and how to add your spouse if the spouse is on the payroll, or the children, um, in order to trigger that intergenerational wealth transfer that we were talking about, and a lot more. These are just a few selected data points that come out when we produce this complementary illustration. To get your illustration, the best thing is to visit the Canadian Physicians Pension Plan website. Or you can always send Dr. Trent an email and say, hey, I want an illustration. And then he'll direct that email to our team, and then we'll start crunching the numbers. You can also request a callback if you don't want to get an illustration, you just have some general questions. And some of the general questions we'll cover tonight, but some of them might be stuff like, oh, what happens if I die? What happens if I get divorced? What happens if I sell my business? What happens if I go bankrupt? What happens if I leave the country? There's always the same questions that come up all the time. So we can answer those without producing an illustration. And we can, of course, request a meeting to discuss your illustration, to go over all the math and the strategy. We can even get your accountant involved. The accountant might have some views on all of this. So we're happy to speak to your accountant. So that's it for the formal presentation. Thank you for your attention. I'm going to pass the baton back to Dr. Tran. And again, thanks for your attention.
Thank you, JP, for the presentation. What I'm going to do is I'm going to stop the recording here so that we can ask questions, and also you can come on video if you want. So let me stop the recording.